Hi guys, welcome to Mutual Fund Corner. I'm Pavitra Parekh. With me is Sonal Bhutra, and today we're going to talk all about the newly revised investment rules for surplus funds of PSU companies. Now remember, PSU companies were earlier allowed to invest only in debt schemes of public sector mutual funds, but the government just last week changed the rules to now allow investment in all debt schemes of SEBI-regulated mutual funds. So that's an important, update coming through as far as the investment norms go. And Sonal throws up a lot of questions for our guests.
It does, and that's the reason why we have two guests on the show today, Pavitra. Let's welcome Nasir Salim of Flexi Capital and Kaustav Bilapurkar of Morningstar Investment Advisor to discuss new investment rules for surplus funds for PSUs and a lot more as well. Gentlemen, good afternoon. Thank you so much for joining us here on CNBC-TV18. The first question to both of you is the same, but Nasir, let me come to you first because we want to understand what were the rules earlier with respect to investment of surplus funds of PSU companies, and what do you think is the rationale for the change that we've seen now? Yes, Nasir? Okay, we'll come to you in a bit, but Kaustav, your take on this?
Hi, Pavitra. Hi, Sonal. So I think, a couple of things that have, very important, right? So when you think about what the existing norms were and what they've been changed to, so firstly, like you mentioned that earlier PSU companies were allowed to invest in debt schemes of only, what they defined as public sector mutual funds, right? With, government or government entities holding greater than 50% shareholding. And there are a couple of other regulations which stay in place, but, they're important from the context of, why some of these tweaks have happened, right? So they had other guidelines around, obviously, the fund AUM being greater than 1,000 crores at the time of investing, the maturity period being, up to a year and nothing beyond that. And if I couple that and I look at, some of the existing sort of government-owned entities, and I think that's important to note because when you look at the list, I think SBI is obviously one of the largest ones there, but the others, and remember UTIs after their listing is no longer a greater than 50% sort of government-backed entity. So that kind of whittled down the list of asset managers, asset managers that were available for PSUs to invest in, and secondly, the other metrics that were applied, 1,000 crore minimum AUM, only going into funds and fund categories that would limit it to a year, and also very importantly, coupled with the 2025 rule that SEBI applies, that means that not more than 25% of a fund corpus can be held by a single investor. So all of that kind of limited the overall sort of schemes of funds that were available for PSUs to invest into. By opening that up to now all mutual funds, all asset managers, that essentially kind of gives a much broader investing option to the PSU companies to go and look at some of the private sector entities too, expanding the universe of funds that they can potentially invest into.
All right, that is on, what could be the perhaps the reason behind this kind of move and, change in investment norms. Let me also bring Nasir into the conversation. I know there was an audio issue earlier, so I hope you can hear us now, Nasir. And, coming to the same question that we were just talking to Kaustav about as well, what do you see as the rationale behind this, and what do you see as sort of the scale of the impact that it can have on debt flows as well?
Good afternoon, and thank you very much for having me on your show, and congratulations to both of you for starting this episode right from the top. So basically, Sonal and Pavitra, I think the rationale is very, very simple. If you go back to history in 2017, there was a guideline issued, which is basically for central public sector enterprises, which basically said that you could invest in mutual fund public sector MFs, which have more than 50% of holdings by the government. Now, frankly speaking, this was done by the Department of Investment and Public Asset Management, DPAM, which we kind of know them as, and they've now issued a modified guideline because obviously the bond market today is at a very, very important cusp as far as India is concerned, both from a domestic and from a global perspective. We've been talking about the JP Morgan bond index inclusion globally as well. So the government is now looking at this very, very closely, and therefore, the entire idle surplus cash, which is basically with listed public sector companies, and that quantum is huge. It's close to about the last number that we kind of researched was a 1.58 lakh crore. Now, all of that was not being able to get access from a level playing field to the private sector MF companies. I think that has now been addressed because one, it will obviously, the rationale is it will help in, bringing in more liquidity in the bond market because there's going to be a higher participation. Number two, I think the rationale is very, very clear is that, when we do this, it's obviously going to get a lot of fillip to the entire mutual fund industry as well. The last number that we saw today is about 40 lakh crores that is being managed by asset management companies, which means both private and public. Now with this, benefit coming in, that number will start to increase.
Okay. Point taken there. Kaustubh, let me come to you because the Finance Ministry says that the period of maturity of any instrument of the investment made by a PSU shall not exceed 1 year from the date of investment, with the exception of being the investments made in banks and government securities. What are your thoughts on this? Is this 1 year period limiting the investments or the entire rationale of this move that has been made?
Yeah. So when you think about the legacy, right, traditionally, I think a lot of, corporates and especially the PSUs have been pretty sort of conservative with their investments. And when I put it in the context of the current interest rate scenario, I don't think it's particularly disruptive, the 1 year mandate. And the reason why I say so is simply because, when you think about where the yield curve is, it's kind of flattening. So what we call it. So, if you were to look up to, maturities of 1 year and beyond, the spread between the two is not very significantly different, right? So the trade-off is actually in favor. And even when we talk to a lot of fixed income managers, the trade-off is in the favor of the shorter end of the curve. So from a near-term perspective, we don't see that much of an issue. I mean, for two reasons, like I outlined, obviously just the conservative nature of the PSU companies to not really get into interest rate risk, and obviously, where the yield curve lies currently. But I think going ahead, and perhaps, that will be a roadway or a roadmap, which they will look at that, can this be relaxed potentially? Because there are other fixed income funds or instruments that can be, beyond this, which could be interesting from a perspective for, the PSUs to take exposure, but that's probably some ways down the line. I think from the current context, it's a good start, I would say. But yeah, I think it would need to be rationalized, perhaps going ahead.
Okay, so that is on that 1 year tenure which has been, put in place by the government. But Nasir, coming to you, we were talking about these changes. Now that they have, been put in place, how do you see the real investment into mutual funds changing? And just for the benefit of our viewers, what do you mean by surplus? And, what is the surplus that these companies are allowed to invest?
Great. Yeah. So basically, I think the point to be noted here is that apart from the fact that, public sector companies are conservative, which I agree with my fellow panelists, I think the important point is surplus of funds. Now, surplus of funds in this particular case, I must tell you, is not funds which are available in the bank account or cash balances. But the condition is that surplus funds basically in this case means available with central public sector enterprises after meeting the business requirements, which include operating expenses, tax payments, working capital, debt servicing, and capital expenditure. So mostly all your statutory payments, post those payments are done, the money which is left idle is available to be deployed up to 1 year. That's the first condition. The second, which we obviously are waiting for further clarity, I must tell both of you, is that the DPAM outline has mentioned that these have to be invested through TREPs. I don't want to get into a very complicated discussion on this, but TREPs are basically nothing but tri-party repo rate systems, participatory systems, whereby which they're allowed to invest. Now, given the current condition, broadly speaking, the first thing that comes to our minds is could it be overnight funds or a liquid fund? But the mandate has again been changed by SEBI in 2020, both for liquid funds and of overnight funds. So I think that is in particular that needs to be seen. How this is going to come in and benefit the current schemes that are available to the public at large.
Okay.
The third one is, of course, is that, as I said, the period of maturity remains 1 year, up to 1 year. So it can be, 1 month ranging up to 1 year. And the other very important condition is that the guideline is that they do not want any involvement of agents or for that matter, any brokers. So I think these are broadly some of the main conditions that have been outlined at the moment.
Understood. So, Nasir and Costa, we'll do one thing. We'll quickly get into a commercial break. We'll come back and we'll continue with this discussion about these new investment opportunities or guidelines as far as surplus funds for PSUs are concerned. Stay tuned. Welcome back. You're still tuned into Mutual Fund Corner on CNBC-TV18, and we still have with us Nasir Salim and Costa Belapurkar, and we are talking about the new rules that have kicked in as far as surplus fund investing from PSUs to other mutual funds now. Costa, I wanted to understand how important is the timing of this move, considering the rate scenario we are in. We're talking about how funds into debt funds are going up, rates are going up. What about the timing now?
Yes, Sonal. So I think it's an interesting timing because, clearly, the interest rates have moved up, across the curve, like I was alluding to earlier. So, it is a good time for, the PSUs to kind of deploy that surplus cash, which is probably not earning enough returns to kind of some of these funds, which can potentially, generate higher sort of, returns for them. And like I said, even within that, 1 day to 12-month space where they can kind of operate, there's several types of funds, which obviously the treasury managers of these PSUs will look to deploy. And, because the rates are reasonably attractive as they were compared to maybe a year ago, I think definitely a good time to look at, from that deployment perspective. And like I said, given that while that applicability of this was there, but given the limited options that the PSU funds had in terms of just deploying that money across funds, other than SBI, there were very limited options that met all the criteria. And now this just opens that up to the whole gamut of, investments across the board. So that's definitely, I think, a good time, for PSU managers to kind of look at investing in these debt funds.
Okay, got that. Nasir, you come in on this as well, because this is also a time when you will usually see these short duration funds, ultra short duration funds, seeing greater flows, right? So how do you look at this coming in at a time when we are in this interest rate scenario?
I'm more gung-ho about this entire fixed income space over the next few quarters and over the next 1 year or so, for sure. Because, I must tell you, the asset class as fixed income is going to be very, very rewarding for short-term investors and for, corporates such as these which are looking at the opportunity. I think if you look at the scenario broadly, today we are all central bankers, and I'm trying to spend a few seconds on the current scenario. Today all central bankers are looking at increasing interest rates because, we are battling inflation. This morning itself, the Fed has just gone into a meeting as far as the US is concerned. And globally, everyone's talking about controlling inflation. Now, when you do this, the only way to do this is you start looking at increasing interest rates gradually. And I think, RBI has also done that beautifully in the last few quarters. And therefore, if I were to just compare for your viewers and for you, the last 1 year, yields that were available between, just for example, an overnight fund or a liquid fund, we had come down to sub 3.5% for short-term instruments in India. Today, a 1 year maturity in between a 1 year maturity, say an ultra short, between 9 months to 1 year, you can fetch close to about anything between 575 to 6.25 perhaps, depending on which category you choose. Now that's a great number. It's almost a 250 to 300 basis points, 2 to 3% higher yield that you're getting into. And this is not stopping because the RBI is obviously may look at further interest rate hikes. So therefore, I think the timing is very well placed at the moment. If you just compare the last 1 year yields I just told you, which I'm trying to basically get at, it's at far more attractively positioned and priced in. And I think, the announcement could not have been timed better than this.
That is right. So, Costa, we are talking about, of course, this will change the investing pattern. But can you give us some numbers? How much of a boost should we expect to the debt schemes in terms of flows? What is the current surplus, if any, if we have an approximate amount that is lying with the PSUs as we speak?
Right, Sonal. So, I'm probably not the authority in terms of the surplus, but, I read sources that said about in excess of 2 lakh crores that is available. But remember, there's the other guideline that says only 30% can go to mutual funds. So if I do the math, about, in excess of about 60,000 odd crores overall can be invested by the PSUs into debt mutual funds. I don't know how much is invested today, but I suspect that, not a very large portion of the 60% plus thousand crores is actually invested today, given the constraints that I mentioned, in the past with the number of schemes that they could invest into. So definitely there's going to be money coming in, and on an ongoing basis, it'll continue to add to the AUM and the liquidity in the market, which is definitely going to be a net positive for sure. So I think that's where we're looking at in the sense right now.
All right. I'm actually going to take that liquidity point forward because that is the other benefit, right? So how much do you think that this can really help with the liquidity situation in the bond market? It's anyway quite good, I mean, within the debt space. And how much do you think this revised regulation can help in this department?
So I think liquidity, like you rightly said, especially in that segment where they'll look to operate in is actually pretty good. But the point being that the more participants you get, the more flows you get, and it just becomes much and much more liquid, which is great. And I think the roadmap, and this is again maybe I'm thinking ahead and looking ahead. Potentially, this is just the first step they're putting in place in terms of with the maturity bucket of 1 year. Because I was doing some digging, and this is even before I joined the industry, but in the past, maybe 2.5 decades ago, they even allowed equity investing. So I'm not saying that we're going to get there, but I'm saying, there are instruments that, the PSUs can potentially benefit from beyond just the 1 year maturity bucket, even in the fixed income space. So I think they will look to expand this. They'll obviously observe how this pans out over a period of time and then maybe take a call. But the idea is that it's only going to be a sort of net positive to liquidity, which is a good sign.
It is a good sign, of course. So, and you're saying it's just one of the few earlier steps that the government is taking in. So let's see whether there are more updates, something that comes up in the budget or otherwise as well. Nasir, we're talking about 42 AMCs currently, and most of them are actually private. So, of course, a move like this will be positive for flows into private mutual funds. How much do you expect this to pick up? What is the outlook in general? Of course, you can't give us exact figures, but a ballpark number or a ballpark movement or flow that we are expecting here? Okay, so looks like we have lost that connection with Nasir again. Kaustab, okay, he's back with us. Okay, that was quick. Nasir, please go ahead.
Yeah, sorry, could you repeat the question, please?
No worries. So we are talking about 42 AMCs being in place currently. Most of them are private, of course. This move will be positive for flows into private mutual funds. What kind of flows are we seeing? Do you really think on ground there will be a big shift here?
Absolutely, Sonal. I think so. See, the first thing is, I think if you look at the way the decision framework works within a PSU, is that not all of this idle cash will necessarily go. That's the first thing we need to remember, because there is a board decision that a PSU, that under the PSU treasury kind of goes and talks about, and they get approvals in place. So I think one is the fact that not all of this money necessarily may go into the MF space, but it's a great welcome step. I think if I look at the last numbers, Sonal, which we kind of dug out, the idle surplus available as of 31st March of 2022, balance sheet number is about 1.58 lakh crores. Now, obviously, this number would have moved up because we are 9 months thereafter, and so our sense is, given the 30% regulation that was just mentioned, and that there is a PSU Treasury Board decision that will take, my sense is, give or take 20-25% flip of that 30% should definitely start flowing in. So if you look at broad numbers, it can add up to anything between 25 to 30% on that 1.58 lakh crore, ideally. Obviously, it's going to bring in a level playing field. There's also going to be more competition. As we say, competition attracts efficiency, and thereafter, brings in, better returns. And obviously, it augurs very well for the overall MF industry as a confidence building measure. One last point I think on this is that, apart from the liquidity that will start coming in, today a lot of investors who were particularly looking at only fixed deposits will start looking at this, because it's also going to add a lot of fillip to the mutual fund Sahi campaign. Because if you're looking at large companies, and these companies are not very small, I mean, they're very large listed public sector companies. I mean, the names of, BHEL, Coal India, Hindustan Aeronautics, BEL, I mean, these are very, very large names. And obviously, if they start looking at investing in this bucket, apart from the fact that with liquidity improvement, there'll also be sentiment positivity that will add to the entire mutual fund industry.
All right. So that is, the kind of flows that we can expect into private mutual funds now as well. Let me come to you on this as well, Kaustubh. Do you have any kind of calculations as to what kind of amount we could see in terms of flows into private funds? I mean, of course, we know this will be a positive, but how much do you expect this to pick up?
Yeah, Pavitra. So, like Nasir was highlighting, and I kind of mentioned earlier, so, the estimate of, say, about 2 lakh crores of liquidity surplus, maximum up to 30% in mutual funds. I don't think a very large portion of that is already in the public sector mutual funds, given the constraints that were in place earlier. I think this will, definitely, come in over a period of time. And like Nasir rightly pointed out, there is a committee approach to the way the investment decisions are made. So it could potentially take some time, but, on a long-term basis, it's definitely a net positive, not just in terms of money coming into funds, but, the sentiment that Nasir very rightly alluded to, that it's just going to add more and more credence and heft to, a retail investor on the street thinking about, hey, this is a great investment vehicle for my own portfolio. So I think definitely it's going to, not just this number, but it's going to add a lot of, basis to flows coming into mutual funds, continuing flows.
Okay, Kaustubh, Nasir, thank you so much for joining us, explaining these new guidelines. So definitely a welcome step. More can be added to this, and there will definitely be a shift to more private mutual funds. Thank you so much for joining us and simplifying this for us. And with that, it's a wrap on this edition of Mutual Fund Corner today. Stay tuned for Closing Bell to take you through the last hour of trade.